Hey guys, Freaky Finance. So I just finished my general idea video, and now we're going to do a more standard video on Primaris. So Primaris is a REIT, specifically in Canada. They own, basically it's just a shopping mall portfolio, enclosed shopping malls. There are some open airs, but mainly enclosed. And you can see where they're generally located, quite a bit in Ontario, and for population-wise, they actually have quite a bit of exposure in Alberta. And one of the things that interesting with shopping malls is no one really wants to own them because they're perceived as all being destroyed by Amazon, right? Not like you're just thinking of like your Sears and your Target pulling out of Canada and stuff like that, right? So one of the things that's nice about this company is that it screens fairly cheap. And these are the type of assets that they own. Just to kind of give you a visual example before I really jump into the numbers. You can see that own quite a bit of properties, not a lot, like there's only 35 listed here. And again, mainly in Ontario and Alberta. And Ontario generally has the bigger ones, but Kelowna has some pretty big ones too. So what I look at here is the GLA. We're going to go through the tenants on a different one, or it's easy to read. It kind of just tells you the type of malls that they own. So if you ever wanted to Google them like I do, like I don't actually own this one yet, but I'm thinking about it, right? And so I like to, okay, where's this at? What does it look like on the outside kind of thing, right? What I'm actually buying here, right? Because all REITs is you're just a landlord, right? You just get the flow through the cash flow. That's the idea. And I actually really like REITs. I haven't done that many videos on them in a while. Generally, I do them when I think they're getting cheaper again. And currently, one of the things that's been happening, I kind of talked about at the end of the other video that I just put out, is utilities have done quite well, but REITs have sold off. And we're talking about a delta of around 20%. It was a little bit worse earlier in July. What I mean by that is, say utilities are up 1% on the year, REITs are down 20%, which is interesting because REITs are generally another way to contract cash flow depending on the industry. Enclosed malls are a little bit different, but most of the tenants, the WALT here I think is about 4.5 years, or weighted average lease term, sorry. It's about 5 years, 4 or 5 years, so not crazy high, like office leases would be average longer. Industrial REITs probably have a decent WALT too, but so I'm looking at this one, and quite a few industrial REITs. I might do one on Dream Industrial REIT too. That also started looking pretty exciting, and I like some of the moves they're making on the capital structure side. But anyway, Primaris, enclosed REITs, so you got these malls. And the thing that I like about this REIT, the main selling point, is that it has an NAV, so the net asset value is $22 a share, or $22 a unit, but the share price is only around $14. So you're getting this company that's basically trading in the equity markets $1 billion cheaper than the assets that it represents. And that's because the market perceives enclosed malls as things you don't want to own. And we're going to go through the numbers of what's happening right now, which is kind of exciting, and you're getting this nice discount at the same time. And what the company is doing to take advantage of the discount, which is probably the most important thing. Well, aside from the tenants still paying. That's always the most important thing. So this is an example of a mall. So you can kind of see this one, Devonshire Mall, I think was one of the bigger ones. All right, Devonshire, yeah, 875 square feet. All right. So, yeah, one of the bigger malls. That's what it looks like on the outside. And just kind of how I view it. So we saw in the thing that Cineplex was a tenant there. Cineplex is actually finally recovering, but it's actually has been pretty bad for a while, for about 2 years now. I still think they win their legal case against Cineworld, but that's neither here or there. Metro, so grocery anchor chain. Shoppers, fairly stable. Then you have different ones that I'm not familiar with, right? And the location looks pretty good. It's right beside Detroit, so you're pretty much very, very tip south of Canada, where a lot of the population is, and this is where quite a lot of the enclosed malls that they own are. And they're generally in higher income areas, like they own quite a few around, like they own one in St. Albert, one in Sherwood Park, over in Edmonton, which are generally higher income areas than Edmonton itself. Not necessarily true, but it's generally consensus. And there's other ones that they own, but again, it's very Alberta and Ontario focused, with the bigger ones in Ontario, generally. All right, so probably one of the most important things for a REIT is the tenants. That's where the cash flow comes from that you as the REIT holder eventually get. You can see a decent amount of high quality tenants with some mixture of weaker apparel names, as you'd expect in enclosed malls. But overall, the main thing is it's super concentrated. There's two names together that are worth only 10%, so not very concentrated. There's no one tenant that's like worth 30% of the income or something like that, which is more of a risk. Even something that approaches 10, like Canadian Tire, is the biggest risk here. And that one's only BB, so barely investment grade. But Walmart's a steady one. You have the Loblaws, which are still doing fine. I remember I did a grocery tenant. I think I did Slate Grocery REIT a long time ago. That's a similar idea. So that's like a stable income. That's what I mean. Bell and Rogers, we talked about them. They're both doing well. Cineplex is finally recovering. We'll have to see what numbers they put up. I think they report next week. What else is there? Really, that's all I look at is how concentrated it is and what's the weighted average lease term for the guy, right? So apparently they've signed on Walmart for 7 years. They've signed some of these small guys. Look for the shortest one, right? So Bell. Not too worried about Bell. Those Bell kiosks that you see in the enclosed malls in Canada. Hudson's Bay, probably one of the weaker ones, but again, it's only 1.3% their total rent. And then some will be coming back finally. Like Good Life Fitness is probably going to do better this year than they did during the last 2 years, right? Imagine not having to wear a mask during working out. Anyway, it's kind of what I look at during the process. So not a lot of concentration risk with the tenant, fairly stable. It's like what you'd expect in enclosed malls. That's one of the risks, is that if enclosed malls do dry up, then obviously they're going to have problems because it's going to affect all those tenants all at once in that mall, right? But at least they're diversified internally into different ones. So say if Best Buy goes bust, right, or something like that, or Hudson's Bay goes bust, it's only hit by that technically at that specific point in time, and then they can find a new tenant for that place, right? Basically, you don't want all of them to go away at once, kind of thing. Anyway, one of the things that I like about this company is that it's very low debt to the asset base. It's probably structured that way for a reason, because they don't want to take on too much debt, because the market already perceives enclosed malls as being riskier, right? So they only have 28% debt to total assets, which is pretty low. I mean, I want to say the average is probably around high 30%. And then generally over 40 is when you start getting maybe a little bit riskier. Then over 50 is when you kind of got to make sure you're watching the covenants and what's the payout ratio on the dividend. So how high is that dividend yield versus their actual ability to pay it? Anyway, maturity schedule is okay. They have some mortgages payables coming up, but I think they're going to keep pushing these to be unstructured. So basically they pay off the mortgage and then they roll it on an unsecured debt. And I'm sure they should be able to get a decent rate at the lower debt level. So one of the reasons why I'm doing a video today is that they just reported on August 3rd. Today is August 6th. A little bit later than the last video. I think I started that one around 6 a.m. This one, it's currently around 9 a.m. Like, you guys need to know that. But anyway, this one's interesting. So basically what's happening is they're getting more income from the same property, so 15% more NOI. And you can see they basically say half is from post-pandemic recovery, so they're higher rents, improving tenant sales. So one of the things in your enclosed malls, you'll get base rent usually, and then you'll also get kind of like a rider on the sales. So if your underlying tenants are doing well, they'll actually pay you more in rent. So it kind of aligns you with your tenants. You want your tenants to succeed, and you'll get more rent for it, kind of thing. And it also gives you usually a floor at the bottom, like no matter what, this company's going to pay this amount each month, kind of thing. So you get the certainty of that with a little bit of upside. That's one of the reasons why I'm doing this video, is because it's actually doing quite well. And we're going to go into tenant sales in a second. We'll see if that's sustainable or not. I don't know. But it does look pretty good at this point. And again, I don't own this one, but I'm just doing a video on it because I think it's interesting. Then you have some that's kind of more one time, so prior year's property tax and a decrease in bad debt expense. So more of their tenants are paying better, so they don't have to incur as much bad debt expense, aka write off the rent that they didn't collect. The payout ratio is still just around 50%, which is very nice. So you might be like, oh, it's a pretty high dividend yield, right? I think it's 5.7 or something. It might be over 6. Depends. I think it used to be over 6, and now it's rallied a bit. It's a pretty good dividend yield, right? But one of the things that I like, besides the low debt and low payout ratio, is that they have a low amount of uncovered assets. Or sorry, a high amount of uncovered assets, and they also have this NAV that I talked about, the big discount. So they're traded at 14, but their professed net asset value is 22. One of the things that's cool with this company is because they get all this cash flow, and they're only paying out so much in dividends, they're getting this extra cash flow, and what they're doing is buying back their units. So they bought back 1.4 million units, right, at an average discount of 36.5%. So they're trying to close the NAV discount by buying back the units. And so I like that. So basically all the remaining unit holders get more FFO. But really the comments here was really exciting. So it's like, throughout 2022, our enclosed malls portfolio experiencing significant rebound in tenant sales. So that's opposite. So the reason why I did the first video first, because it kind of showed like a mixed picture. Some companies are slowing down materially, some are not. Enclosed malls, interesting enough, is not slowing down, which is funny, right? But it makes sense because the watermark is so low because COVID pretty much destroyed the enclosed malls, right? So they're having these easy comps and revenue's finally coming back. People are going out more, and we're seeing that across the board in all different types of companies that have reported so far. So it makes sense, but people for some reason don't think of it. And obviously the share price where it is, no one believes in it. And that could also be just the general market slowly trading down, right? I mean, this multiple compressing, but cash flow looks steady. It's actually getting better, which is a weird thing to say during a period that looks like we're entering a recession, right? Anyway, that's all I'm trying to say here. The main thing, aside from the net rent collected, is an increasing or decreasing, is the occupancy. So the occupancy was at 86, and now it's slowly climbing up committed capacity, so it's different than occupied or normal. So normal occupancy up a bit, which is nice. It should be slowly getting higher, especially as rents are increasing. You would imagine that they're able to increase it for a reason. It'd be nice to get this over 90. But anyway, committed occupancy is 87, and you can see that the weaker occupancy is in the Hoop properties that I think they merged with an Ontario company, I believe, when they made this REIT. It was a spin-off of H&R REIT that I've been following. I think I did a video on that a long time ago. Anyway, so this one's the tenant one, page 7. So this is the tenant sales over time per province, and you can see the impact that shutdowns have on it. Management compares the recent tenant sales activity to pre-pandemic sales activity. So how are the tenants actually performing during this kind of environment? And you can see in June 2021, it was weak in Ontario, which is, again, critical to the business. These two provinces are the most critical for this company. So anyway, you can see that June 2021 was weak. And that reflects closures and capacity restrictions to the response of various local governments from the increase in infection rates from COVID. And again, you had it in January with the Omicron variant. You had the sales dip from 93 to 69, right? So pretty big difference. Like as soon as the government imposes restrictions, you see a reflection of that in the public and consumer behavior. So that's the main driver, but you can see over time it appears to be going back to 2019 levels. Like they're all above the rolling 12 months right now, so things are definitely better than they were. And so they're trying to continue or not, all I know is that the company is still very cheap, right? And this was their prior quarter, and this is the one where it was interesting. I'm pretty sure this one talks about food traffic. Let me just see. Yeah, food courts. So basically, well, January sales lagged. So this is during the Omicron, but they just reported after Omicron was still impacting people's behavior. They basically said portfolio-wide sales increased 97% to pre-pandemic levels in both February and March, so it rebounded quickly. And then talked about food courts, which I thought was interesting at the time. Typically, a barometer of mall traffic continued to show rising sales activity, with the February and March sales being at 80% compared to pre-pandemic levels. They were still improving it back then, and now it's only gotten better based on this trend, right? You're at 103 in a lot of places. The main one is Ontario, right? So back then you're at 70, even 90, but now you're at 95. And that might sound small because it is kind of small, but that's 4% more in a quarter, right? not bad growth from really just recovery. You're not really growing. You're just recovering from what was lost before, but you're at a better share price. That's the idea, and it's nice because I always like REITs because you get that steady cash flow, right? Usually I view them more defensive, and so when I have utilities that are also more defensive, trading at all-time highs, I have Pepsi trading near all-time highs, right? The U.S. consumer staple, that's pretty secure. And I got these companies trading down 20%. I'm starting to think, okay, I could get some kind of, on the defensive side, I could probably pull some from my outperforming utilities and buy some that are REITs that are gone down with the general market. Especially REITs that are at discount. And you can see here is when the spinoff happened, H&R REIT. It's at 12.5, and it recently got down there, and then it kind of rejected it on as the last 2 weeks. So that's one of the reasons I was looking at it down here and I didn't pull the trigger, and now it shot up on me. So I'm not going to chase it up here ultimately, but you can see why it's improved because the fundamentals keep improving. Net operating income keeps improving as tenant sales keep improving, right? And this is just down with the general market. So you can see the market gives you a lot of opportunities to buy into things that are actually improving while things sell off with the general market. And who knows, it could come back, right? Sentiment could just get just as bad as it was just a month ago, 2 months ago. Anyway, so this is probably the summary page for me is most important on the REIT. We've already talked about occupancy, talked about the tenants. So the asset to liabilities, we talked about debt, but this is what it shows. So basically they owe $1 billion in debt on those properties, those 35 properties. But on the books, they have the properties worth $3.2 billion, right? So you have this $2.2 billion in net assets. That's what the equity owners own. So the people that would buy the units. I believe this trades PMZ.UN on the Toronto. Pretty sure. But anyway, basically that 2.2 billion is the equity holders, but the thing is the equity market cap is only around 1.3 billion. So you're getting this almost $1 billion in asset value that's the market's currently not giving the company credit for, which is about a third of the business, which hence the discount of 36% that they're buying back their shares at that they calculate. So you're getting basically $3.2 billion worth of property value, allegedly, at a price of $2.2 billion. Right? That's the idea behind the NAV discount. So whether you agree with it or not, it's an interesting margin of safety, right? That's how I view it. And then you have the margin of safety on the FFO payout ratio. So the dividend yield looks high. It's actually not very high at all. They could actually do more. And what they're doing with the extra cash flow is buying back the units to try to close the NAV discount. Right? So I like everything about that there. Weighted average term to maturity could be longer. All right, you always want to push that out just in case. But you do have a decent WALT, so weighted average lease term was definitely over 4 if I remember. Again, this is just the investment properties and the assets. So this is the balance sheet. You can see that most of the debt, only $475 million, is mortgage. So these are already unsecured debentures. Only have 101 on the credit facility. So pretty good structure for debt, right? So that's what I like too. Is that it's a riskier and closed mall play, but the debt is pretty low. So I like that one. All right, and this is a short video. I think I talked too much in the first one. So REITs are generally easier to understand too. They're easy to convey. You're just the landlord. You have the properties, and you're just basically giving money from the tenants to the unit holders and the debt holders. But my perspective is always the unit holder. Here's the cash flow statement. Most important thing for a REIT besides the balance sheet. You do have these items on affecting cash. So usually that's them either increasing or decreasing the property value. So the property value is when you're when you're a REIT, you mark them up or down based on market. Well, you should. And so as interest rates increase, they actually mark down their property values. And as things transact at a lower price than what they're currently booked at, they'll also mark down their property values. So this can make the REITs look like they're not earning as much, but it's all non-cash. And then over time, generally what you have is the property values increasing, right? And then your mortgage is slowly going down as they pay out with the cash flow, right? Just like a house, right? Just like this house. So you buy the house, then you have the mortgage, and you slowly pay on the mortgage, and the house value slowly appreciates. Usually, not always, but usually. That's the same idea here, but you have 35 different properties, 35 different malls, 35 different areas, right? So, and with different tenants. So it's a little, it's obviously different, but it's the same idea. And basically slowly build value over time, one from the actual steady cash flow that the tenants pay, but then you also get some value over time from the actual underlying property value, or you should. And this company at this point looks like the market's not giving them much value for their underlying property assets, or it doesn't believe in the current valuation of the enclosed malls. Could be a number of different things. But what I'm trying to point out here is that it can lead to volatility in the earnings per share. So when you look at a company, they're like, well, this company looks a lot worse than it did last year, right? Why are things better? And it's like, well, they were marking up their properties last year, and now they're decreasing their property value this year. And you go, okay, well, why are they decreasing their property values? One of the things during kind of like contractionary periods like this, I guess we call it that if you don't want to call it recession. But whether it's recession or whatever, I don't really care. All I care about is what's going to happen. So here is they're decreasing the property value, but they're doing it because of the interest rates. They're not doing it because other properties are transacting, because during a period of contraction, people are no longer willing to buy and sell as easily. So liquidity dries up is what I'm trying to say, which means that there's harder time to value assets. So at a time when you really want to value them the most, during periods of perceived crisis, you really can't. And so usually you're at the mercy of whatever markets, and sometimes they transact at the bottom, then all these REITs mark down their property values at the same time, and it usually puts more pressure on the REITs, so you usually get even better deals. And then once the crisis is over and the asset values slowly appreciate back up like they generally do, you get this steady step up over time again. So it's a fun little game in REIT land. And here's what I'm trying to show with the cap rate. So as the interest rates increase, the sensitivity on the property values. So like I said, currently, let's just say they had $3.2 billion in property value. As of June 30th, using this discount rate, they say they have fair value of income producing properties at about $3 billion. And as interest rates increase down here, you can see the property value go down. So 0.75 increase, it's about 10% less in property value. That's how they deal with increasing rates. Importantly, I didn't talk about this one, but this one had 81% fixed interest rate expense for debt. So it won't actually increase the debt expense, or the interest expense rather, as interest rates keep rising. Again, my angle is that eventually interest rates are going to come back down. The yield curve is basically telling me that it's going to invert, or it's already inverted. It's basically telling me that there is going to be a recession, or at least it's going to be a slowdown. At either case, once inflation finally cracks, which we should start seeing, maybe not this print, but maybe the next print. I don't think it'll get higher, because I'm already seeing shipping go down. Where like Walmart's talking about pushing out the inventory really hard, so that's going to reduce margins on the apparel side. We have energy finally rolling over. We had copper roll over. We had a lot of things starting to roll over. We still have housing that's year over year still increased. So on average. So that's still going to put pressure on CPI, but I think we're probably approaching peak. And then depending how weak unemployment gets, right now unemployment's still doing well, which is kind of freaky. Right? If all this layoffs is happening, right, that we keep seeing, then it should in the advertising pullback that we did see, right, and the shifting in behavior that we did see, we should start seeing more weakness in unemployment, which will make the federal governments finally stop raising rates, causing more of a recession. But right now, the main thing is inflation, so they're probably going to over-raise rates. And then as soon as inflation really starts showing that it's declining with unemployment sharply increasing, we should start seeing a pivot. But it's still pretty early, and you don't really know when, right? But anyway, all I'm trying to say here is it could be some more short-term fair market value decreases, and then eventually you're going to get this slow, steady increase, and that's usually the best time to buy these REITs. I mean, now this one looks really good because you get such a big discount. Like I said, you get $3 billion worth of property for the price of $2 billion, right? So that's why I like it, and it pays a good dividend. We already talked about it. It has decent tenant structure. Maturity schedule could be better. The interest rate probably could get better, but honestly, it looks pretty good. But yeah, and hopefully I can get a stab at it when it comes back down, because I'm not going to chase it up here when it's just moved outside 2 standard deviations really quickly. But once it comes back in, I might buy it. We'll see. I love REITs. They're just so much easier to visualize and explain. But yeah, I'd like to know your thoughts. I'm probably going to do a few on REITs because I'm seeing quite a bit of opportunity, but I just don't want to jump in too early, right? Anyway, have a great rest of your week.